I'm an executive director at Curzon Energy. Curzon Energy is a newly listed company. We floated about just under a month ago on the standard market of the London Stock Exchange. We raised £2.3 million, and these funds will now be deployed to put our first asset to production and cash flow by April of next year. So we have a strong target of basically delivering cash and production in 6 months' time. The asset in question is a 1 TCF gas field located on the Pacific Northwest coast of the state of Oregon. It's an originally a coal mining area, as oftentimes with coal bed methane reservoirs they start out because you know a lot about the coal and the extent and its characteristics. We acquired this asset out of an administration from a group of lenders for a valuation of $4 million. Which is about 10% of the sunk cost into the project by the previous operator, which was $37 million. This puts us into a fantastic position where we now are 100% owner and operator of a 45,000 acre lease position with two very industry-friendly landowners. One of them is a logging company. We are in a logging area in the state of Oregon, so they cut down trees while they build roads, so we have very easy access to all of our facilities and infrastructure. We have, as I mentioned, about a TCF of gas in place. This is per third-party CPR. We have 273 BCF of 2C resources. The main reason this is in the resources classification at this point is because we still need to execute a gas sales contract. We have a letter of intent with a pipeline operator and offtaker to do so, and are executing on that at the moment. We have 12 wells drilled by the previous operator in 3 different sites. You can see those on the thing. We have a Westport site, Beaver Hill, and Radio Hill. Of those 12 wells, 5 are still operational. They're currently shut in. Now, they do produce gas. We have all the equipment on the wells to do so, but they're not connected to the sales pipeline. So our funds that we raised as part of the IPO are now earmarked to put these 5 wells on production and tie them into the pipeline, plus drill 2 new wells to basically demonstrate the cost of drilling new wells and also the efficiency gains that have been made over the last few years with new completion techniques. So there, as I mentioned already, there are a lot of nice things that we like about this. First of all, we know it produces gas and has tested gas already at quantities that we believe are commercially viable to move us to a full field development. What a full field development looks like is that on our lease position, we have room for up to 400 wells. That would be about an 80-acre well spacing. We would produce up to about a 500 BCF total volume from these wells, and the rate of returns at pricing that we receive are between 20 and 45%. One of the other great things here is, which you can see, is we have a gas sales pipeline going straight through our acreage, which again, with some of these stranded gas reservoirs with this to some degree is access to markets. So we are right there, and we're literally 10 meters away from the gas sales line. We have an intra-field pipeline that connects our 5 existing wells to that, and we literally now just have to hook it up to the main line. We've had the pipeline company out. They have looked and selected a tying point, and we're now going through the process of connecting to the line. Test data, as I mentioned, we have very encouraging test data at the site where we're starting re-entering these 5 wells and connecting them to the line. We've produced up to 100,000 cubic feet per day peak rates, but established over a 3-month period of 68. We need 50 plus to be commercially viable. We now need to demonstrate that over the long term, but over a 3-month period, we've seen these wells going from 30,000 cubic feet to 68,000 cubic feet. At the 2 sites further south, we've actually managed to have rates up to 500,000 cubic feet, but those were only for a very short period of time, and we do need to go back to these areas and confirm that that is the case and also can be done long term and establish that that is actually viable, because sometimes those tests, when they're so short, it's hard to project forward that they can actually do this on a sustainable basis. But nevertheless, gives us a lot of comfort that once we put the first 5 wells and 2 new wells on production near the pipeline and get to cash flow by April of next year, we will then go back to these sites and confirm those with new wells as to what the durability of the coal down there is. So overall, a large position that we own of control. We know gas flows. We know we can sell it. We know we can deliver it to the market. We have a very low royalty rate of only 12.5%, which is about half what you would pay in Texas or Oklahoma if you get into one of those basins. And last but not least, we're selling gas at premium prices. The letter of intent that we have with the operator indicates that over the last 5 years they paid an average of $5 per MCF, which is 40% premium to Henry Hub at the moment. These are some pictures from the field. As I mentioned, it's a beautiful countryside, but it's logging area. Logging companies come in here every 30, 40 years. They cut down 20 acres and then move on to the next 20 acres, and they keep coming back. They are very friendly towards us because obviously they will benefit from our production as they are the royalty and mineral owner. This is when we put the 2-inch gas pipeline in place. I mean, the company that we acquired, put that in place. And very simple setup. We have 9 drill sites, drill pads already in place. They are larger than a football field, so we can, as we step into the next phase of further development, we can drill half of our wells from existing infrastructure without having to build new roads or new pads. The question that we're asking now in terms of commercial viability and getting this to production is basically, are the test rates that we have in the field so far, can they now be supported by long-term production as we put these wells online? The type curves that you see here are from our competent persons report. They estimate that based on the coal that we have and the gas characteristics and the coal characteristics that we should expect to start production between 50 and 100,000 cubic feet per day. As I mentioned, we've already established that in one of our wells on long-term test, which puts us straight in the middle of this. Plus, we had tests between 200 and 500,000 cubic feet in wells further south. Again, we need to confirm and establish that that is a long-term rate that we can support. But overall, it gives us, as I mentioned, a lot of optimism here that we might be able to actually do better than what we have today with new wells. The reason why I'm saying that also is because here, all the 5 wells that we currently have that we intend to re-enter have only been completed across half of the coal that is productive. Why the previous operator has done that, we don't know, or we can only speculate that because they ran out of money towards the end, they only completed the top half of it and not the bottom. More gas is actually contained in the lower part of the wells. So what we will do with the first 5 wells is we will only go clean out any. We know that there's some old frac sand in there that we want to clean out. We'll clean those out, put those wells back on production. So we believe the fact that these have made 68 to 100,000 cubic feet against these conditions, we might be able to do better. Plus, if we drill 2 new wells all the way down to the bottom, we think we might be able to do better. But at this point, we're not banking on it, and actually we don't need it for this to be commercially viable, as the type curves show you. As long as we stay between, or if we get to around 100,000 cubic feet, we have a project. The other thing that you can see on this slide is that the well economics are very strong at the prices that we expect to receive, with even on the low side, we're delivering a 22% rate of return. Well costs are cheap. We're drilling down to 2,000 feet, so we're spending between $300,000 and $350,000 to drill and complete these wells. In terms of how simple this all is, there's always risk, obviously, with this type of appraisal in early development stages. But what you can see here is, so we have our 5 existing wells in green that are already connected up to a 2-inch gas pipeline. We are now going through the process of connecting this to the sales line with a compression manifold. We have water disposal in place and all the permits in place to dispose of the produced water. We're putting the produced water into an estuary. All the water has been tested for compatibility, and we have the permits to do so. Once we have completed phase 1, which again we're fully capitalized to complete this and get to first gas, we will then assess the performance of these wells, see how they compare to our expectation. We will update the market with a new reserves report at that time. If everything goes according to plan, which we obviously hope it will, we're then embarking on phase 2, which means that we will drill another 58 wells within a predefined core area where we already have most of the infrastructure in place. You see these are drill pads. So we can drill probably a third to a half of these wells from existing infrastructure. The value of a fully developed phase 2 project, as per the reserves report, is about $34 million in PV10. We currently have a market cap of about $8 to $9 million, depending on what we're trading on the day. So IPO investors, I think, are getting a fantastic risk-reward proposition here, putting something into production that we know flows and produces, and getting visibility on the next step here. To close this off now, our timeline, again, very simple and straightforward. Following IPO, we're now executing as to what we've told the market we would do. We're getting everything in place to re-enter the wells, execute the gas sales contract, and get to first production within 6 months, which we believe is going to be April 2018. Following that, we will assess the performance of these wells. That will help us fine-tune phase 2 development. And at the same time, obviously, we will then start looking at the next round of financing. If everything goes very well, we'll have cash flow to drill some of these next wells. We'll have debt capacity. But depending where the share price is, we might come back to the market, or we will be looking for a farm-in partner at that point. So again, what I want to stress here is a very simple, straightforward story of getting a partially appraised and discovered gas field into production. The uncertainty is really exactly how these wells will perform, and that is more a question of how we optimize phase 2 rather than, in my view, whether this will work or not. Thank you very much for your time. So if you have some questions, please.